ETF demand bumped higher last week, forcing the shift in geography from New York to London. Plenty of silver, but in the wrong place. That's the gist of it. And the implications have been that silver in the spot market has temporarily dislocated, with lease rates exceeding 200%.
And it's normally at like 1.5–2%, isn't it? A lease rate, maybe 3.
Even less.
Yeah.
Even less. But this whole event, again, the lease rate has skyrocketed. 200% is something you see once in 100 years. 200%.
You told me yesterday 200%, and I walked away thinking it was 200 basis points. No, 200%.
Yeah. So, the drama is in hedging inventory. Hedging spot silver has increased to over 30 cents per day per ounce hedged.
Wow.
And again, it's basically your silver price, 200% of that divided by 365, you come up with your daily rate.
So give us an example of what that would cost. Let's say on 50,000 ounces.
Right. So sitting on inventory hedged as so many in the market do because you don't want to take risk. 50,000 ounce position times 30 cents would be $15,000 a day in new hedge costs. So $30,000 for hedging the weekend.
Whew.
Prices had started the week in contango, where the spot price is cheaper than the futures price. And if you can just imagine a forward curve, we're familiar with sort of the, interest rate curve, right?
Right.
And typically it rises the farther out in time you go.
So spot would be what you would consider the short end of the curve, and the futures market would be the longer end of the curve.
Yep. So contango is when you've got a gradually steepening curve. Backwardation is when you have the opposite, a curve that falls off, where in essence the spot price is higher than the forward month contract.
Right. So it becomes costly to hold inventory if you're in backwardation.
Yeah. As the week progressed, last week we shifted from contango towards backwardation. Backwardation, again, when the spot price exceeds the front month, which has the effect of introducing a financing cost for that inventory. So from being paid on inventory to paying for that inventory, in our example, $15,000 a day. And, you can see margin calls and a demand for liquidity. And that's not unique. But falling over a weekend when that risk cannot be mitigated, and frankly, over a 3-day weekend, including a bank holiday here in the United States, means that settling the margin calls isn't possible till Tuesday, something of a liquidity snowball.
Isn't that interesting how timing can sometimes catch you? I mean, Columbus Day, of all things, right? It's like, wait, we have margin calls. I'm not talking about us, but I'm talking about these large entities that are highly inventoried or leveraged on this stuff. They can't meet the margin call because they can't raise the liquidity.
Right.
Yeah.
Yeah. So, I mean, it gets more interesting because it's not just the lease rate. If you want to unwind the hedge, now you're talking about a difference in bid and ask, which could be $1.30, $1.50, $2. So, combined, multiply times the ounces you have hedged to unwind the hedge and to cover that lease rate, you're talking about $2.10 to, at its worst, maybe $2.90 per ounce. Let's round up to $3. Right. So
that can be spready, right?
That can be painful.
Yeah.
So this is temporary. JP Morgan immediately sent 20 tons of silver from New York to London. HSBC another 20 tons, and other groups in aggregate of 40 tons from the U.S. And there's the potential for more than that, actually, something of on the order of 150 to 200 tons, all told, between Hong Kong, Singapore, going to London, and from New York.
Okay, but to repeat, basically, a lot of that silver was here based on the fear of Trump tariffs earlier in the year, right?
Yep, that's right. Yeah, so given the normal delays of offloading pallets from a 747 and checking the product into London inventory, the product which was sent Saturday will be all settled and in place by Wednesday. So 80 tons will hit the London market. Additionally, 100 tons is lined up to be delivered by next Thursday here from the U.S., and then I mentioned what's coming from Asia as well. But if you just look at the U.S. sourced product heading overseas, $298 million worth of silver, it's on its way.
Yeah.
So the issue is largely resolved, except for the increase in hedging costs, which will take time to normalize.
Isn't it interesting, though, how different this market is? A physical market is so different. We saw this in the oil market a few years ago, where having oil in inventory actually became costly. Remember that? Mm-hmm. But this is a real thing. This is not a secret number like a cryptocurrency. This is a real thing that needs to be in a real geography somewhere else, It's
Yeah, maybe we can come back around to this in our conversation, but the irony is that the danger factor was in the de-risking of the position.
The hedging.
You want to hedge, and yet the hedge cost moves to a level that it's no longer sustainable, and it forces an unwind. It forces a liquidity event. So this is, I think, something to contemplate when we think about the equity markets. And, if you're concerned about stocks being at a high level, maybe you're one of the few who's begun to hedge a position. But the cost of hedging can increase with time and can ultimately become unsustainable. We had that in 1987, where it was hedging strategies, dynamic hedging strategies, which compounded the losses to close to 25%.
It was the insurance against risk that actually brought things down.
That's right.
Yeah.
Right. So the net effect is, if you're looking at the physical gold and silver market, the ask price for silver is high, and the bid is low. The bid is the price you're offered when you're liquidating.
That's that spread you were talking about.
Yeah. So if hedging inventory, a buyer in the wholesale market would then have to discount that product to account for carrying the inventory over a period. So at 30 cents a day, anticipating a 10-day holding period for the inventory, you would put the bid $3 lower, $3 difference between bid and ask. And that's just to make sure you don't lose money. That's not you being opportunistic or price gouging. Somebody wants to liquidate silver and they see the spot price at 50 and the offer where the bid is at 47. Well, this is it. And I can't tell you what the expected inventory hold is. Maybe 10 days is too short. Maybe it's just a day. But demand is strong. If it is, then it drives the ask price. Hedging is still an issue that has to be addressed. Hedging costs remain high, which means cautious inventory management. Really, you can't afford to pay more in the market if you're playing the market-making function, then it will cost you to buy and hold the inventory.
And this just really strikes me as a reason to make sure that, if you're an investor listening to this, it's good to actually have physical product, actually own the physical product, because there is counterparty risk. Even in the physical commodities markets, you've got to have liquidity available through the banking system, like this Columbus Day issue. And you also have to have things in the right place at the right time.
That's right. Where this gets interesting is with any global player that held inventory hedged in the spot market. You got margin calls over the weekend. Particularly in the U.S., where a bank holiday prevented the settlement of those margin calls. To not cover ounces at the market open on Sunday would have been a mistake.
Right.
To cover those ounces at the market open cost at least $1.30 per ounce to $2 per ounce. So we've been in this a long time. You don't let your losses run.
Right. Well, it reminds me of a Shakespeare play where a pound of flesh was the cost. Remember that?
So we lost a finger. We didn't lose a limb.
Right.
But your first loss is the best loss. We took a modest haircut on closing out a short position and have no worries going forward. So smart players, I'm sure, did the same. Not everyone has those kinds of risk controls in place. So with the price hitting $53.56 on Monday night, there are some players who likely lost the 3 days at 30 cents, plus the difference between bid and ask. Call it $1.50 to $2, $2.40 to $2.90 an ounce.
Yeah.
Again, just there's a lot of folks that will hedge 1 million ounces.
Right.
So
I'm thinking about leverage. What about the guys who are leveraging this stuff? It's even beyond what they actually physically own.
Right. So you hedge to avoid losses on your inventory. In this case, the hedge was the risk. And I think that's worth thinking about, because if the markets are assuming that you have liquid and normal functioning as sort of the prevailing conditions in a really pressured period of time, that's not the case. Liquidity dries up, and there is nothing normal, right? So we had a very abnormal weekend. The same thing, I think, could ultimately apply to the equity market.
This is why you got no rest after the client conference. You went from meeting everybody to actually handling a crisis in the metals market.
Yeah. So that hypothetical 50,000 ounce position that we were talking about could have cost you as much as $145,000. That's basically between 5 and 6% of the value of the position. And going forward, the risk of backwardation and steep carrying costs is what lingers in the market. Odds are that we stay in backwardation through the end of this contract roll, which would be the December contract.
Right.
You may very well have prices that rise, but don't expect to liquidate with a strong bid, because as long as that cost to carry is high, it is what it is.
Well, back in the 70s, the late 70s, everyone has heard, or virtually everyone has heard about the Hunt brothers, but your dad knew Bunker Hunt, I think, quite well. And some of the dynamics of the market at that time, that 1979 run-up on silver and then the subsequent crash based on rule changes, let's talk about that, because that's, in a way, some of these mechanisms that we're talking about now were in play at that time.
I know one of the traders who worked for the Hunt brothers, and as a part of the settlement with the government, he was banned from trading commodities for the rest of his life.
Wow.
They went after the Hunts without any mercy. And believe it or not, the Hunts didn't purchase an ounce of silver over $15 an ounce.
That's what I heard.
So a lot of the frenzy in price was, the investor coming to the market and playing the momentum trade. And, but I think there is a similar dynamic this weekend to what played out in 1979, 1980. You had short positions. They pressed industry players, groups like Makata, which you mentioned earlier, pushed them to the wall. And COMEX intervened to the benefit of its members, including Makata, who were hemorrhaging hundreds of millions of dollars a day. Of course, it destroyed the Hunt brothers' silver position in the process. And one of the ways that COMEX did that is they changed the rules in the futures market. Again, this has nothing to do with the over-the-counter market or the physical gold market. But COMEX changed the rules in the futures market to sell only. Those were the only trades that you could place.
You couldn't buy. You could only sell.
That's right. Only sell orders, and the price retreated. That saved Makata, saved others. That sounds shady.
Yeah.
Well, it is.
Yeah.
It's not always what you know, but who you know. And the Makata brothers, one in London, one in New York, they knew who to call.
Yeah. When you're too big to fail, that doesn't mean that everybody's too big to fail, right? I mean, you can tap them. And so, do you think that they'll do that again?
I don't anticipate COMEX doing that today. Of course, they can change margin requirements. The amount of money that you have to have is sort of skin in the game on a futures contract. You don't have to have it fully funded. And that is where you can find, forced liquidations, where somebody has to come up with more money to keep the trade in.
Right.
That they do is a way of making sure that there's adequate skin in the game. It is a normal process in a rising market, whether it's corn, soybeans, wheat, gold, silver, what have you.
Right. Right. And increasing the margin requirement, just to explain, is if you can put 10% down to control 100% of something, at some point, they may say, no, we want the 100%, or there are occasions, I remember in the palladium market, they actually raised it to 200% when there was some problem.
Amazing.
Yeah.
Ordinarily, it moves in smaller, increments from 10 to 15, from 15 to 25, from 25 to 50. Right. That 100% margin requirement would be their way of saying, we're not really interested in you placing the trade. In fact, they're encouraging you to sell versus buy,
right?
Because you've got to come up with a lot more money.
Show me the money.
Yeah. So the physical market is very different than either of the two we've been talking about, spot or futures. And supply and demand, clean and neat as it is in the over-the-counter market. Products are priced as a reflection of supply and demand. So price, I think, more accurately reflects reality in the OTC market, in the physical metals market. In the futures market, you don't have to have the product, and you can make a leveraged bet in either direction. And I recall the fall of 2008 in the early stages of the global financial crisis. Gold prices dropped between 20 and 30%. And that's usually at the front end of a major liquidity crisis. You see people scrambling to raise liquidity so they can keep their bets in play. And then at a later stage of a deleveraging, they realize that they probably want the security of the metal more than the bets that they were trying to maintain. And so a dip in price, pretty normal at the front edge of a deleveraging.
Because it's so liquid. But this absolutely exemplifies what you're talking about, the difference between the cost of something now versus the cost of something later, right?
Well, yeah, because in the futures market, the gold prices dropped 20 to 30%.
Back in 2008.
Yet to acquire metals for immediate delivery, the price was the same.
Never dropped.
You were sitting at $900 to $1,000 if you wanted immediate delivery.
Yeah.
And only if you were willing to accept March delivery, that's 4 months later, could you get the discounted price tied to the futures contracts and the future delivery of material in the supply chain pipeline.
So I'll gladly pay you Tuesday for a hamburger today. Is that, that concept is in play here, isn't it?
Well, people were willing to pay the premium, the over-the-counter premium for immediate delivery,
right,
because real-time counterparty concerns in the context of 2008 and 2009 overwhelmed that drive towards bargain hunting. If you think, well, I'd rather save myself an extra 20, 30%.
Right.
I'll just take delivery in March. That really wasn't the spirit. What if the future was worse than the present and the product was not available as expected? Or even worse, COMEX played another of their tricks. They settled in cash instead of in kind, because those contracts don't have to deliver metal. They have the opt-out mechanism of settling in cash, closing out paper contracts with paper script.
Do you think the pain that was suffered by some of these larger wholesalers this weekend, do you think that is possibly going to readjust their mindset going forward as to their way they're holding gold and where?
I think it might, and I suspect it'll have a recalibrating effect on the investor mindset as well.
Okay.
And physical metals in the over-the-counter market should become more interesting, and I think with them an increase in premiums. We've had an extended period of time where central banks have driven prices higher, and so official buying, as they like to call it. And investor appetite for metals expressed particularly in areas like the ETFs, in the form of ETFs, they've driven demand for large format products. So that's large gold bars for GLD, that's 1,000-ounce silver bars for silver.
It's the stuff people don't hold in their hand.
Yeah,
right? These
you wouldn't want to. But ETF demand is a critical force multiplier for the metals market, and it continues to be the easiest avenue to satiate investor demand. Refiners can crank out large format product with incredible efficiency. But as the demand for metals increases via ETFs and refineries meet that demand with freshly minted bars, the refineries will necessarily cut back production on small format products like 1 ounce, 10 ounce, 100-ounce silver and gold. There's another factor here too, which is they are subject to the lease rates. And it may be that they don't produce anything.
So if they've got 1,000-ounce bars in the back room and they know they're going to make coins out of them, okay, what you're basically saying is if they're having to pay a lease rate on that, the lease rates, there's a cost to not getting that turned into a coin right away, right?
Right. I mean, there is a scenario where because of high lease rates, which they've come down from 200% to 51% today.
51%.
Yeah, 51%.
So if they better keep coming down.
Again, just roughly translate this. If I'm holding a silver inventory for 365 days, it will cost me $25 out of the $50
half
in
the price of the silver
just to borrow it, or in this case, as we view it, insure it.
Yeah.
So,
wow.
Yeah, this scenario is interesting because if lease rates stay high, refineries do not have enough margin in the product that they produce, either 1,000-ounce bars for the ETFs, large format bars for GLD, or the small products that consumers are more interested in. And again, it's just because of the mechanisms. It's because of the process involved. They lease the gold, they're paying for it, and that costs them something, but that's okay because they produce it and sell it at a certain margin. Well, if the lease rates are too high, it squeezes their margins, and it is better for them to do nothing. It is better for them to not produce product. So you will see how long these rates stay high. Maybe it's a week. My guess is that they are somewhat stubborn through the December contract roll.
Could this be an environment then where we start to see premiums rise on material that already exists in small format?
Yeah, so these are the kinds of environments that stimulate premium trades. And maybe that's American Eagles, maybe that's junk bags. Anything small format could see over the next 6 to 12 months a healthy increase in the wholesale market premium. If there's not new product being manufactured by the refineries, now you're working through the old inventory, secondary market product.
Well, and it reminds me of what occurred just a couple of years ago with the silver American Eagles. I mean, it didn't rely on lease rates, but if you recall, there were not enough silver American Eagles to meet the demand. And so the premium jumped way up. We moved out with our clients into 100-ounce and 1,000-ounce bars. We waited, and then when there was enough product, we moved back in. And compounding ounces is a beautiful thing, Dave.
Yeah, as I recall, if I recall correctly, in that last period where the premiums on Silver Eagles were, 50 to 70% over the spot price, that was when the mint shut down production. They basically said, we've produced what we were going to. We met our quota for the year.
Time for vacation.
But there was still demand in the market.
Right.
And that demand in the market had already eaten up all the primary production. Then it went to the secondary market for all the backdated products. As soon as that product was gone, then we also saw premiums on junk bags increase. I think we got 30% out of that particular trade. And so, compounding ounces, that's been a key differentiator for a company. And it's this kind of setup that allows for compounding. So the key factor, which has to normalize, is hedging costs. Those have to come down. And if that happens, then bids will rise, right? Otherwise, the bid-ask spread can continue to sort of remain blown out. And premium trades, you can't capture them. You have to have the ask price move, but the bid has to follow.
Right.
And that is going to be a function of the call it the cost of capital.
Yeah, cost of insuring the capital, right?
Yep.
Yeah.
So as I mentioned earlier, the market resolves these price issues quickly via arbitrage. Most people, however, are not prepared to lease 747s and fill them with 1,000-ounce bars for delivery to London.
That sounds like a James Bond movie, doesn't it? I mean, filling 747s full of silver, getting them back over to London so that you can settle a trade.
Yeah, but some people are. Some people are prepared to do that. Some people already have captured the price differential between London and New York. And ARBs or arbitrage opportunities last but a second. And only the experienced industry trader is able to take advantage of that.
Right.
And you go back to COVID and remember the Cushing WTI where oil is trading negative.
Right.
Right.
What was it, negative $30 or something a barrel? It was crazy.
I forget the exact
If
figure.
you had inventory in oil, it cost you didn't own anything.
Right. It costs you to hold the inventory.
That's crazy.
So not everyone has the resources to float a tanker with oil and wait for prices to normalize. But if you do, and did, and prices normalized.
Well, okay. Yeah, the price is normalized. But do you remember how volatile the price of oil was during that period of time? Should we expect that with silver? I mean, is silver going to maintain over 50 right here, or are we going to see some real volatility because of this?
Yeah. That's anyone's guess. I mean, it remains to be seen if silver can maintain prices over $50. It could correct, but every day it remains over $50. The likelihood of $60 and $70 silver by year end increases. An 80-to-1 ratio still argues for leaning into a silver position, thus far, gold has been the better investment over the last 4 or 5 years, and you really need to see that ratio begin to move, into the 70s and 60s and 50s for that trade to have paid. Thus far, guess what made the difference in a metals portfolio? Diversification. If you're 100% silver, you've been mostly wrong until this year's move. So 3-4 years of having some explaining to do.
Right.
And really that kind of singular bet implies that you know more, you think you know more than you actually do. So we do like to diversify portfolio across gold, silver, platinum, palladium. And so when I describe leaning into a silver position, it would be increasing the percentage allocation compared to the norm.
Right, but not giving up your gold. Having some gold in the portfolio as well.
That's right. That's right. But if the ratio's momentum shifts and crosses over to the 70 to 1, the 60 to 1, that's when silver will have been worth owning. More to the point, if refineries are now on alert, what are we going to produce? Is it going to be large format bars to meet ETF demand? Will they even be able to do that given the high lease rates? I think certainly more investment dollars will flow to that small format product. It's immediately available. There's no fuzz on it. There's no delay in delivery. And actually, there is plenty of product available. So if somebody's saying, oh, there's a silver squeeze on. Yeah, not really. I mean,
there's plenty of silver so far. It's just in the wrong place in the wrong format.
This is a London squeeze.
Yeah.
It's not a silver squeeze. And it happens to include silver. But I think that distinction is important. So this weekend was a wake-up call for ETF providers, wake-up call for refineries. They're going to need to address supply lines and make sure that they are positioned as best they can. The complicating factor, of course, is tariffs. We don't know exactly what tariffs will be applied,
right?
If any, money and metals moving one direction or the other.
Yeah, so silver being an industrial metal is a little different. Trump already said he doesn't want to tariff gold, but silver is an industrial metal. You could see copper or anything coming from certain countries tariffed, right?
Yep, and you have your own arbitrage opportunity as an investor in the small product market. Gold and silver, lowest premiums in decades, but I don't think those premiums are likely to stay there long.